Somewhere in Singapore right now, someone is opening a letter from IRAS. Not because they are a criminal, not because they tried to cheat the system, but because their numbers did not match what IRAS already knew. And IRAS already knew a lot. In 2026, the Inland Revenue Authority of Singapore is not waiting for you to make a mistake. It is watching for it in advance. The auto-inclusion scheme now feeds employment income data from over 123,000 employers directly into the tax system. More than 2 million Singaporeans received their tax bills this year without filing a single thing, because IRAS already had their numbers. And if your numbers disagree with the ones IRAS already holds, you are not getting a second chance to explain yourself quietly. You are getting a letter. Here is what makes this different from previous years. IRAS collected over 5 million Singapore dollars in penalties from nearly 37,000 taxpayers in the last assessment year alone, just for late payment. That is not fraud. That is not evasion. That is ordinary people who did not read the fine print. Now add to that the enforcement raids in March 2026, where investigators hit over 20 business locations in a single day, seized 179 luxury watches worth more than $1 million, and arrested a 56-year-old woman for GST fraud. IRAS is not messing around. So today, I am going to walk you through the 5 biggest red flags that are getting Singaporeans audited right now, what the system actually sees when it looks at your return, and exactly what to do about each one. Stay with me until the end, because the last red flag is catching people completely by surprise, and most of them have no idea it applies to them. Let us start with red flag number 1. And this one is bigger in Singapore than almost anywhere else in the world. Undeclared platform income. Grab, Foodpanda, Gojek, Carousell, Shopee, Lazada, YouTube AdSense, TikTok creator payments, Airbnb room rentals, and the home tuition sessions you run on Saturday mornings. If money came in, IRAS wants to know about it. Here is why this is so sharp in 2026 specifically. The Platform Workers Act came into effect on the 1st of January 2025. For the first time ever, ride-hailing and food delivery workers operating through digital apps are now a formally recognized legal category in Singapore, with mandatory CPF contributions flowing directly from the platforms. Grab, Foodpanda, and Lalamove are now reporting your income to CPF Board and IRAS as part of that process. This is not voluntary, it is built into the law. The threshold that triggers a declaration obligation is a net trade income of 6,000 Singapore dollars or a total gross income of 22,000 Singapore dollars. Below that, no filing needed. Above it, you are legally required to declare everything, and IRAS uses artificial intelligence to trace undeclared payments flowing through fintech payment gateways. Here is what catches most people out. They think of their Grab driving or their Carousell sales as extra cash, a few $100s here and there. Surely IRAS does not care about that. But IRAS does not draw a line between your main income and your side income. It draws a line between declared and undeclared, and if the platform has reported your earnings and you have not, the system flags the mismatch before you have even closed the tab on My Tax portal. Red flag number 2 is rental property income. And this one is uniquely dangerous in Singapore because IRAS has a weapon that almost no other tax authority in the world possesses to the same degree. Every tenancy agreement in Singapore must be stamped through the IRAS e-stamping portal within 14 days of signing. Every single one. And because every stamped agreement sits in the IRAS database, the system can automatically cross-reference the list of stamped tenancy agreements against the list of landlords who declared rental income. If you stamped your tenancy agreement and did not declare the rent, that discrepancy is visible to IRAS the moment tax season opens. Between 2024 and 2025, IRAS investigated 793 property owners and recovered 4.8 million Singapore dollars in additional taxes and penalties from that exercise alone. The second most common rental mistake is confusing a repair with an improvement. If your air conditioning unit broke and you fixed it, that is deductible. If you renovated the kitchen and put in new marble countertops, that is a capital improvement and is not deductible. Not today, not spread across years, not at all for individual landlords. IRAS has seen renovation invoices labeled as maintenance many thousands of times. Their auditors know exactly what $30,000 of quote-unquote repairs on a 2-year-old apartment actually looks like. The third mistake on rental properties is claiming only the mortgage interest portion, not the principal repayment. Many landlords who are newer to investment property claim their entire monthly mortgage payment as an expense. IRAS only allows the interest component. If you do not know the split, check your bank mortgage statement. It is broken down there every single month. Red flag number 3 is where Singapore takes a completely different position from most countries, and understanding this difference could either save you a lot of money or cost you everything. Cryptocurrency. Singapore does not have a capital gains tax. It never has. That means if you bought Bitcoin 3 years ago, held it, and sold it at a profit last year, there is a very real chance you owe IRAS nothing at all. Singapore is genuinely one of the most crypto-friendly tax jurisdictions in the world, and that is not marketing, it is law. But here is the catch. IRAS does not decide whether you are an investor or a trader based on how you describe yourself. It applies what is called the badges of trade test. It looks at how frequently you trade, how short your holding periods are, whether you have a deliberate profit-making intent, and whether the trading looks more like a business than a personal investment. More than 50 transactions per month, holding periods under 6 months, and regular systematic activity are the markers that flip you from investor into trader in IRAS's eyes. The moment that happens, your gains become taxable business income, assessed at rates up to 24% for high earners. And it gets more specific than just buying and selling. DeFi yield farming, liquidity pool rewards, and staking income are generally treated as business income the moment they generate consistent returns at scale. Airdrops are taxable at fair market value on the date you receive them. NFT flipping for profit as a regular activity is a taxable business. And starting in 2028, Singapore has committed to international data exchange under the Crypto Asset Reporting Framework, meaning exchanges here will be reporting client activity to foreign tax authorities. If you moved here from another country and have unreported crypto activity from before your arrival, now is the time to get clean. Red flag number 4 is the one that nobody is talking about yet, and it is new to 2026 in a way that matters. Influencer and digital creator income. IRAS published dedicated guidelines on this and has made it explicitly clear that social media income is treated as business income under Singapore tax law. Every dollar that Instagram, TikTok, YouTube, or any brand partnership puts in your pocket is taxable once your net business income clears 6,000 Singapore dollars per year. That is a deliberately low threshold. The average meal deal sponsorship on an account with 20,000 followers clears that in a month. What surprises most creators is the scope of what counts as income. Cash payments are obvious, but a luxury hotel that flies you in for a stay worth $3,000 in exchange for content coverage? That $3,000 is income. A beauty brand that sends you products worth $500 for a review? If it happens regularly, or the value exceeds $100, that is income. If a brand pays your friend or your partner in exchange for your endorsement, that is still your income. IRAS has been watching this space closely because the compliance rate among Singapore's growing creator economy is, to put it politely, not high. Penalties for negligent underdeclaration start at 200% of the tax undercharged, plus a fine of up to 5,000 Singapore dollars. For deliberate evasion, that becomes 300% plus up to $10,000. If you are running a serious content business and treating it as a hobby for tax purposes, you are one audit away from a very uncomfortable conversation. Red flag number 5 is the one the system catches most automatically. And it is where IRAS's data capabilities are most formidable. Lifestyle to income mismatch. IRAS has directly stated in its own compliance guidance that purchasing a high-value property or luxury vehicle without a corresponding income trail will trigger follow-up. And in Singapore, this calculation is sharper than almost anywhere else because of one uniquely Singaporean factor: the Certificate of Entitlement. A Toyota Camry in Singapore costs around 170,000 Singapore dollars. A BMW 3 Series pushes past 220,000. That is before fuel and insurance. If you are declaring $50,000 of annual income and you just registered a $200,000 vehicle, IRAS does not assume your parents helped with the payments. It sees a gap between your declared income and your observable lifestyle, and it raises a query. Add to that the income splitting trap. Some business owners register multiple companies to push income below certain thresholds and reduce their tax exposure. IRAS explicitly flags this as an audit trigger. Structuring your affairs with the primary purpose of reducing tax through artificial arrangements is not clever tax planning. It is a compliance risk with a 400% penalty attached. The same logic applies to business directors who mix personal expenses into company deductions. Overseas holidays claimed as business travel. Family restaurant dinners repackaged as client entertainment. A luxury watch on an expense report. IRAS has seen all of it, and it has the transaction records to cross-check. So before we wrap up, here's the one thing that changes everything if you have made any of these mistakes in the past. IRAS operates a voluntary disclosure program. If you come forward before IRAS finds you, the penalty drops from up to 400% to up to 200%, and criminal prosecution is taken off the table. The maths is simple. Staying quiet and hoping is 4 times more expensive than coming forward. If there is something in your past returns that does not hold up, the VDP exists precisely for this moment. Use it. 3 things to do this week. First, log into My Tax Portal and check what IRAS has pre-filled about your income. Compare it against every income source you had in 2025. If something is missing from their file that you earned, you are responsible for adding it, not for waiting to see if they notice. Second, if you rent out any property and stamped a tenancy agreement, make sure that rental income appears in your return. The stamp duty cross-reference is automatic. And third, if you trade crypto, do the badges of trade check honestly. Not the version where you tell yourself you are an investor because it sounds better. The actual version. IRAS is not the enemy. Every single dollar it collects funds the hospitals, the MRT, the schools, the HDB subsidies that make Singapore run. Its job is to make sure everyone contributes their share. Your job is to make sure your tax return tells the exact same story as the data it already holds. Because in 2026, the gap between those two stories is a lot smaller than most people think. If this video helped you, hit that like button, subscribe to the channel, and share it with someone who needs to hear this before the next tax season starts. I will see you in the next one.